So a grant or retained annuity trust is just a tool. It can be used in a variety of circumstances. And all it is I'm the business owner, and I want to give some shares to a trust for my family or my beneficiaries. And I'm going to get an annuity back that pays me back for the fair market value of what I gave in. So I give in something, it has a value, I have to get a valuation. I get something back in the form of an annuity, paid over a period of years. They range from 2 to 10 years typically. 2-year grants are permissible, and they can be done without generating any gift tax on the transfer. Because if what you give in equals what you get back, or what you get back is at least equal to what you give in, then there's no gift tax. That's the Walton case. Sam Walton's sister-in-law did one of these back in the 1990s. The IRS challenged it, went to tax court, the IRS lost, and now this is proven and permissible under IRS regulations. We'll get into actually some examples of how this works in the next session, because it's a really useful tool. It's not just for business owners. I have a client who sold his business. He's worth about $40, $50 million today. He's got a lot of liquidity. We're going to use grats, rolling grats, to try to transfer appreciation in his estate to the next generation. Because if it appreciates at any rate higher than the rate of inflation, or the AFR right now, which is really low, the applicable federal rate, which is really low, we have such low interest rates that these tools are extremely useful, valuable, essential. You want to use them. For high net worth clients, you shouldn't be just sitting there and watching their portfolio grow. These are things that they should be doing, but it complicates their estate. And some clients just say, I don't want to worry about it. But what it will do is it'll save on estate taxes, assuming we have an estate tax, when the person dies, which gets into a whole other question. So the idea is transferring income producing assets to the trust, receiving income for the trust term in the form of an annuity, and then whatever's left over at the end passes to the beneficiaries of the trust, either in trust or directly. This works when you have appreciating assets, assets appreciating faster than the applicable federal rate. And it works really well. On the other hand, if the assets decline in value or don't appreciate, that's okay. The only cost you have is the cost of creating the grat, which are not terribly expensive to do. So if you transfer an asset in and you don't have enough income to pay it back, you take the interest back. So put it in, works, take it back, like one of our clients had to do. Because unfortunately, his timing was crappy. He put it in right when the market went. Market could again soon, but I've been watching it lately. It's a little volatile. It's very crazy. Okay. The benefit is it leverages our ability to pass assets appreciation to our heirs without having to pay any gift tax or any estate tax. And it can provide a flow of income. The irrevocable life insurance trust, again, is sort of an equalizer for business succession planning. And I use it to, when I don't have enough liquid assets in the estate, to transfer to kids who are not involved in the business, I may use life insurance for that purpose. And so, an example, let's say I've got a business that is worth $10 million, and I want to give it to one of my kids who's been involved in growing it to that level with me. That's just one fact pattern. So I'm going to give it to them when I die. It's going to be in my trust and my will, and that's going to be a specific bequest. And I may have $2 million of other assets, house, and maybe some liquid assets, but everything else is in the business. And I've got 2 other kids. What do? Simple answer is, if I'm insurable, I'm going to go out and buy a life insurance policy. And it would be a permanent life insurance policy to allow for me to transfer wealth to my other 2 kids. Am I going to get $10 million each of insurance for the other 2 kids because it has to be equal? I wouldn't recommend it. It's really the question of what is fair. Because this value of $10 million was built by the sweat and blood of both the founder and the child in this particular case. And so that value creation, there should be some kind of discount associated with it for the other two kids who weren't involved in any way, shape, or form in the business. So maybe you get a couple $1 million each of insurance. I've done that. It really depends on the founder and how they feel about things. They may say, I want the business to be split, but I want to give control to the one kid. Again, the worry that I have over the minority interest shareholder, the other beneficiaries, is they may never see a dime out of that. So you have to build in protections, a shareholders agreement with compensation caps. And does the kid who's involved in the business want to be constrained? It's a long discussion that has to take place. Lots of questions have to be asked. And then a plan can be derived. There is no cookie cutter approach to this, but the life insurance can be an equalizing tool once you figure out what it is that you want to do. So I think the rest of this discussion is, how do I integrate all of this, my business assets with my non-business assets? And I've been sort of talking about that the whole time. The idea is understand what the non-business assets are. What are in IRAs? What are in 401ks? What are in the liquid accounts? And has a financial plan been done to figure out if you want to leave wealth to the next generation? Because not all of my clients really care about that. They're like, well, if I die, I die. If it all goes to Uncle Sam, I have clients who have that philosophy, but your goal is to try to say, well, we can do it in a way that minimizes taxes, that achieves wealth preservation, and passes assets on in some form or another to the next generation. Let's figure out what your goals are. Let's try to sit down and do that and let's look at the non-business assets, your home, your second home, your liquid assets, your other illiquid assets, other investments you've made. How can we allocate these assets in a way that we achieve fairness in the estate plan? And so the first question that you always have to ask is, what is fair? Not what is equal. Because the client will ask me, they'll say, well, doesn't that mean equal? Doesn't fair mean equal? And my answer is always, not always. It really depends on what you want to do, and tell me the facts. Give me your family background. Let me understand what's going on in your family. What is your child who's in the business doing? Are they really running the business? If they are, maybe they should be given the opportunity. I'll give you one last story, and I'll let you guys go. The last story is a sad story of a client who I represented the kid. The father had gone to another estate planner. And the other estate planner, very well-known, excellent estate planner, had built a structure so that the son never really inherited the business that he had spent 29 years building. And in the end, the son upset the father, did something to upset the father. And the father had the ultimate control in the end to turn off the son's control. And he did, after 29 years, in a family business that was built predominantly by the son. It was made extremely successful by the son. These things can happen. You can build an estate plan where you can give your client ultimate control to turn the switch off if anything bad happens, which is not a bad idea from the founder's perspective, but it's not necessarily the best answer from the child's perspective. So it's trying to deal with both generations, or all generations involved, as much as you can. Understanding the downsides of any plan is really important, and articulating it to the client so that they understand that this may not be in the kid's best interest in the long run. And if the client says, well, I have other kids and I want to protect them from the misbehavior of the one, then this is what I have to do. And ultimately it came down to that. The founder felt that the son had misbehaved, and he cut him out. Not, the son was okay, he did fine. Ended up starting up another business and succeeding, became exceptionally successful. But the family conflict and the bitterness that arose out of that was, in a word, irreparable. So planning is essential. Bringing in family counseling is essential. Bringing in the right experts at the right time, absolutely critical. Having a strategic plan so that there can be successful management succession, so the business can succeed. Because usually that's what the founder wants. But if it's a business that's just, a single person, self-employed, and that can't be sold, then you shut it down or you try to sell what you can to somebody else and